Think you missed the market rally? Not even close. While everyone's chasing $500 tech stocks, but the real money might be in 6 companies. They're profitable, undervalued, and one of these stocks grew 38% last quarter, and some still trades under $100. Another pays over 2% dividend at a dirt cheap price. Want stocks with big upside and low risk? Let's break them down. Stock number 1, Seagate Technology Holdings. Ticker STX. Now, Seagate isn't exactly a household name unless you're deep into tech, but it plays a vital role in the digital world. They specialize in data storage solutions, particularly hard disk drives or HDDs. These are essential for everything from personal computers to massive cloud servers used by hyperscalers like Amazon Web Services and Google Cloud. Recently, Bank of America bumped up its price target for Seagate to $145. Signaling confidence in its future. Why? Because hyperscaler demand is expected to outpace supply in the coming quarters. That means a tight market and higher prices for companies like Seagate. In its most recent quarter, Seagate posted $2.16 billion in revenue, a 31% jump year over year. That's huge. Even better, it was their 8th consecutive quarter of gross margin growth. So, what are the pros? Seagate is riding the wave of AI and data expansion. Cloud services are exploding, and all that data has to live somewhere. Their margins are growing, and they're actively negotiating new contracts. Stock number 2, Astroenica, ticker AZN. Next up is Astroenica, ticker AZN, a global biopharma giant. Known for its strong R&D pipeline, Astroenica focuses on areas like oncology, cardiovascular, and respiratory diseases. On June 9th, they dosed the first patient in a phase 3 trial for Enhertu, a promising cancer therapy developed with Daiichi Sankyo. This could become a first-line treatment for advanced endometrial cancer, a disease that is unfortunately rising in both cases and mortality. In 2022, around 420,000 women were diagnosed with endometrial cancer, with nearly 100,000 deaths. By 2050, those numbers could rise dramatically. That makes Enhertu's potential all the more important and profitable. Let's talk about the pros. AstraZeneca has a strong global footprint, a robust drug pipeline, and is innovating in high-demand therapeutic areas. Plus, it pays a decent dividend, which is a bonus for long-term holders. As for the cons, drug development is risky and expensive. A failed trial can wipe out millions in investment. And while they're diversified, regulatory hurdles and patent expirations can weigh heavily. Coming in third is Tenet Healthcare Corporation, ticker THC. This company operates hospitals and surgical centers across the United States, and it's been having a great year. In the first quarter of 2025, Tenet reported $5.2 billion in revenue and a 14% increase in EBITDA year over year. Even more impressive, their USPI division saw a 16% bump in adjusted EBITDA. That's a sign of strong operational efficiency and rising demand. Morgan Stanley just raised its price target for Tenet to $210 and called it their top pick in the hospital sector. Why? Because Tenet is not only expanding but diversifying, especially in orthopedics, which is a growth area for outpatient care. So what are the positives? Tenet boasts strong earnings momentum, a growing portfolio, and focused investment in high-demand procedures. Their strategic acquisitions also give them a competitive edge. But there are drawbacks. Healthcare is always subject to regulatory change, and margins can be affected by rising labor costs or policy shifts. Plus, the company held off updating its full-year guidance, possibly signaling caution. Next on our list is Centene Corporation, ticker CNC. This company operates in the managed healthcare space, providing services primarily to underinsured and uninsured individuals through Medicaid, Medicare, and commercial products. With a forward price-to-earnings ratio of just 7.67, Centene looks seriously undervalued. In the first quarter of 2025, Centene brought in $46.62 billion in revenue, a 15.4% year-over-year increase, and a big beat against estimates. They've had recent contract wins in Illinois and Nevada and improved their Medicaid rates, though total membership slipped slightly to 27.94 million. CEO Sarah London says the company is weathering the headwinds well, despite a tough flu season. Looking at the bright side, Centene has a strong foothold in Medicaid, is actively winning new contracts, and trades at a low valuation. It's a stable pick in a defensive sector. But here's the catch. Medicaid is subject to government policy. If budget tightening happens or regulations shift, Centene could be affected. Also, lower membership growth could pose long-term challenges. Let's move to number 5, HCA Healthcare, ticker HCA. This is a heavyweight in the healthcare space, operating over 180 hospitals and 2,000-plus sites of care across the U.S. In the first quarter of 2025, they posted strong numbers. Inpatient admissions were up 2.6%, ER visits up 4%, and EPS climbed over 20% year-over-year. Morgan Stanley raised their price target for HCA to $410, citing efficient operations and strong margins. The company has been aggressively expanding, recently acquiring Catholic Medical Center and Lehigh Medical Center. Inpatient occupancy is also improving, hitting 77% compared to 75% a year ago. Now let's break down the pros. HCA is a scale player with excellent operational metrics. Their size allows them to weather challenges better than smaller players. Plus, demand for healthcare services continues to rise. But we can't ignore the cons. Like other hospital operators, they face rising labor costs, reimbursement pressures, and the constant threat of regulatory change. But HCA's efficiency helps mitigate those risks. And finally, we have Elevance Health, ticker ELV. Formerly known as Anthem, this company is one of the largest health benefits providers in the U.S. In the first quarter of 2025, it posted EPS of $11.97, more than 10% growth, and expects to finish the year between $34.15 and $34.85. Elevance has been expanding into Medicare Advantage and building out its Carelon division, which provides behavioral health and post-acute services. They also recently acquired CareBridge, which helps reduce emergency room visits and institutional stays, potentially a game-changer in long-term healthcare cost control. So what's working in their favor? Elevance combines scale with innovation. They're not just a traditional insurer. They're integrating care delivery and data to lower costs and improve outcomes. That's a powerful combo. But what should investors watch out for? Medicaid cost trends are rising, and even big players like Elevance can't completely avoid those pressures. Also, the stock is sensitive to broader healthcare policy shifts. Now, just to pull everything together, let's take a quick look at the numbers behind these 6 stocks. As you can see in the table, we've got a healthy mix of companies across tech and healthcare, each bringing something unique to the table. Seagate Technology, for example, is holding steady with a 33.79% gross margin and a 2.2% dividend yield. Impressive for a company riding the AI and cloud storage boom. Astroenica stands out with a whopping $228 billion market cap and a high gross margin of 72.58%. Showing strength in both scale and profitability. Meanwhile, Tenet and HCA Healthcare are generating serious earnings per share, $15.12 and $22.51 respectively, signaling strong operational execution. Centene and Elevance, both powerhouses in managed care, show just how vast and valuable the healthcare sector has become, especially as they generate massive revenues north of $160 billion and $85 billion respectively. So there you have it. 6 inexpensive stocks that offer real value, solid fundamentals, and strong growth potential. But before we wrap up, here's a fun one to think about. What's your investing strategy when the market feels overpriced? Do you hunt for hidden gems or play it safe? Comment your thoughts below. And don't ignore these 7 best semiconductor stocks for 2025. Click on this video here.